Hello and welcome to today's NinjaTrader ecosystem event with Kris Lassen of LizardIndicators. My name is Tiffany and I am a platform representative at NinjaTrader. Before we get started with the webinar, I have a few housekeeping notes. This webinar is presented by NinjaTrader LLC, which is a technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to the NinjaTrader brokerage. Lastly, if you are new to NinjaTrader, please make sure you sign up for your free NinjaTrader demo with real-time market data. Our platform is always free for advanced charting, strategy backtesting, and trade simulation. Before I turn the mic over to Kris, it's important to understand that futures, foreign currency, and options trading contains substantial risk and is not suitable for every investor. It is possible to lose all or more than in the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Also, please remember that these training sessions are not a solicitation nor recommendation, but simply educational in nature. Thank you again for joining us today. And without further ado, it is my pleasure to welcome to the NinjaTrader webinar room, Kris of LizardIndicators. Take it away, Kris.
Yeah, so hello from Berlin, Germany, everyone. I'll just start with a quick introduction to who we are and what we do. That's me to the left here, Kris Lassen, and our market lizard to the right, Harry, also known as Fat Tails, has programmed some of the most downloaded indicators for the NinjaTrader platform. And yeah, before we get started, I just want to mention that I did recover from COVID last week. So not something that I'd wish on anyone, but yeah, the reason why I mentioned it is that I might need to take some coughing break here and there. Not a long COVID, I hope, but yeah, enough about that. Let's have a quick look at what we offer. First, there is the Indicators Spotlight newsletter, where we feature some of the tools found in the indicator library that we offer for NinjaTrader 8. So that's a blog post with a video explanation of a trading setup or a general concept from technical analysis, along with a free download for you to review on your end. And as for the library that I mentioned, it has pretty much become the go-to resource for the NinjaTrader community by now. Collection of open source tools, about 150 indicators in there, all available for a one-time flat fee of $150. So one of the main purposes of the library is simply to provide traders with a wide range of tools to test and review what is a good fit for you, whereas most vendors charge 150 plus per indicator to find whether any particular approach or method is right for you. We offer unlimited access to the entire library for that same price. So as a member, you have access to all 150 tools for a one-time $150 non-recurring payment. And finally, we have the premium suite. And today we'll look at one tool in particular from that section that can be used to locate pullback setups. All pullbacks are not created equal. Some are aggressive, others are a little bit more timid, and a few primitive drawings like this hopefully helps make the point. The main differences between successful and unsuccessful trend traders is the ability to read between the lines and distinguish between viable and less attractive pullback entries. There are many nuances to this, and we'll get to that shortly. But a good way to remember what we're looking for is this hesitant pullback. You want to avoid trend reversals that are overly aggressive, and also make sure that the trend remains intact and not moving sideways in a consolidating fashion. So we'll start off with that, the type of pullbacks that we're looking for and which ones to avoid. Our premium tool, the zero lag oscillator, identifies pullbacks without cluttering your charts with too much information. It is designed to align short and long-term momentum, spotting temporary weakness in a strong and healthy trend. Finally, we'll look at whether we can expect participation from institutional traders and why that may improve the probability of these pullback scenarios. Okay, so first of all, there has to be an obvious price move underway for us to discuss pullbacks. This is a classic example, not perfect, pretty aggressive rejection candle here. The second test of this new uptrend is more to my liking, less volatility, more orderly or hesitant pullback here, which is what we're looking for. I compare that to what we see later on here. Just as we set a new high, there is a significant price rejection, huge red Mariposa candlestick here. And this is the type of pullback you'll want to avoid. It has a much higher risk of failing because bears obviously took control here. And yeah, when we're talking about trends, we really refer to a sustained imbalance between supply and demand. In this examples, the bulls were more aggressive in their accumulation and forced the sellers to gradually raise their prices, creating this price trend. But that level of imbalance, it has to persist. There has to be a reason to keep buying, because if the momentum is tapering off, it is a dying trend, most likely a range-bound or consolidating market, which really is inappropriate for pullback trading. On the other hand, there shouldn't be too much momentum either with the blow-off tops. That occurs when you see an explosion of energy in the direction of the trend, typically expanding the average candlestick multifold, and typical to see that in meme stocks and cryptos. But also when there is a market catalyst event, change in Fed policy or a geopolitical strife, which is what we've seen here the past few days. And what you get then is a high level of emotion, massive ranges, a huge VIX. And generally, you don't want to trade in those scenarios because there is an asymmetric risk reward against you. And as in this case, the rally is very short-lived, so not really a scenario for chasing pullbacks. And yeah, that is a decent segue into the next topic, determining whether the market has a directional bias, and if yes, finding a way to align that with the short-term momentum. So what we're seeing here, the indicator that I've put on the chart is Perry Kaufman's efficiency ratio. That's also known as the fractal efficiency, and compares momentum with volatility, often used as an alternative to the directional movement or the ADX indicators. So in a perfect trend where all bars close in the same direction and there's not much overlap, we see high efficiency ratio readings, whereas in a sideways market, without momentum, just back and forth action, the values will fall and eventually below the chop line here. So that indicates a sideways market. And coming up here, we'll have a look at how to align a long-term efficiency ratio reading with the short-term momentum to identify these pullback trades. This is a 30-minute chart of the Nasdaq futures contract with the zero lag oscillator added on the chart. On one hand, you have the color of the zero line itself. Zero line is separating positive histogram values from negative. So we see here a red zero line and then a cream colored zero line and then a green one. And that is pulling information from the longer time frame. So in this case, the efficiency ratio. You can also put the super trend as a trend filter here. And so for the efficiency ratio, it's telling us whether we are in a trending or a range bound scenario. On the other hand, you have the histogram values indicating the short-term momentum. So for bearish setups, we need negative histogram values, whereas for bullish, we want them to be positive and above the zero line. So in other words, bullish setups occur on positive histogram values with efficiency ratio reading the zero line here, showing on neutral or uptrend scenarios. As for the pullback, that is what these white bars are showing us. So this is a adverse move cutting into and testing the new trend, indicating a setup with a short-term oversold scenario. So if buyers are taking advantage of the dip, getting in at lower prices in a new trend and pushing a continuation move, we get this entry signal with the lime green histogram paint bar here, indicating trend acceleration again. And the stop is then set a few ticks below the setup bar or the signal bar, whichever has the lowest low. And later on, we have a secondary signal that can be used to add to the position. And again, the stop is then readjusted, placed a few ticks below the setup bar or the new signal bar, again, whichever has the lowest low. We see this secondary signal came a bit late at the trend here. We had, after all, other white setup bars earlier in the trend. By default, we've set the secondary signals to go directly from a short-term oversold to acceleration again. And if you pay attention here, we see we have a white bar and then it's dark green and then it's lime green. And so it's not jumping directly from oversold to acceleration. And that is actually something that you can modify in the indicator settings. You can say, I do want to accept these weak signals, is what we call them, where there is a brief pause with this dark green bar and then acceleration. So quite a bit of flexibility in the zero lag oscillator, how you define the pullback signals to appear and plot. Finally, we have some black histogram outputs here, and that just means that buyers are not taking advantage of the short-term lower prices here. We just see they're falling and there's no buying pressure. And yeah, we call that a supply and demand filter. And all of these color plots are actually available as data series. So you can use those in a strategy. And yeah, we'll do a follow-up presentation to this webinar showing you how to call those data series and the signal here as well. So short setups will occur on negative histogram values with the efficiency ratio readings showing neutral here or the red line downtrend scenarios. So following the drop below the zero line here, we see these yellow bars testing the new trend. So this is the adverse move that we're looking for, short-term overbought, where sellers can take advantage of and get in at a discount in this new downtrend. And once we have acceleration, that would be a yellow bar followed by a bright red bar. Then we have the key signal first here, the continuation move and the stop is set above the signal bar high or the setup bar high, whichever has the highest high. Later on, we see these secondary signals, opportunity again to add to the initial signal and resetting the stop, obviously. And there's one scenario here where there's a yellow, bright red sequence where there's no signal, and that is because the momentum is weakening. So there's a momentum filter here that is taking out and filtering out this pullback scenario. In addition, we have a filter for divergence, the supply demand of black bars that I mentioned, and the weak signals. So again, it's quite a bit of flexibility in the zero-lag oscillator and how to define the pullback signals. We've set it fairly restrictive by default, but you can modify according to your own preference and risk tolerance. Have a little drink of water before I continue. Okay, so keep in mind here that we're looking for emerging trends, important to avoid pullbacks that occur when the trend has advanced too far, then less probability, less chances for those setups to succeed. So that is what we've normalized the histogram values here, establishing thresholds, blocking late trend entries or trends that are peaked, that are over the top. So in this case, we blew through both the late entry threshold and also the exhaustion, trend exhaustion threshold for the short scenario. We see here a yellow setup bar and then the bright red, but that is below the first threshold. That's the late trend entry. And then once the outer threshold is reached, no more trades will be allowed until the histogram crosses the zero line again and then resets. So same for the long side, addressing blow-off tops and multifold range expansion that we mentioned earlier. Typically, these high volatility scenarios are short-lived rallies that that you want to avoid. So we see here this acceleration is outside the late trend threshold here. So these normalized thresholds are based on the bell curve and standard deviations, which most of you are probably familiar with. A quick recap or a way to get your head around it is to remember that statistically the data points within one standard deviation represent about 2/3 of the data set. So this expectancy or assumption or prediction, whatever we call it, is what we'll use to find out and gauge whether institutional investors are likely to participate in the market move. And that is where the VWAP, the volume weighted average price, comes in. Prices for every transaction are added and divided by the total contracts traded during the session. And statistically, 68% of all trades occur within one standard deviation from the volume weighted average price. So why is that important? Well, because institutional traders, they don't want to give away or show their hand as they enter the markets. The main challenge for them when entering large positions is to avoid moving the market and keep execution costs in check. And so they're looking for areas where there's plenty of supply and demand, and that is within the VWAP value area, or within this first standard deviation of the VWAP. And this is what the daily VWAP looks like, anchored at the start of the full session here, establishing the volume weighted arithmetical mean of all transactions that take place during the session. Again, about 2/3 of all transactions occur within the first standard deviation of the VWAP, which is this value area here. The light blue is the first standard deviation, where institutional traders are likely to position themselves once prices move towards the outer standard deviation. Institutional traders are likely to take a step back and wait for the market to return to value. The idea, therefore, is to look for pullbacks in this area, being mindful of whether the momentum is intact, while at the same time watching out for these aggressive reversal candles that I mentioned earlier. You may also note that there is a red and a blue stapled line that's sort of like the VWAP trend indication. Red when prices are moving below and blue when trading above. We also see how we can use the standard deviation bands as dynamic support resistance. So break down of the long scenario here, absence of buyers, and then support at the lower first standard deviation, return to the VWAP, and then support at the second standard deviation before we returned to value here and got a key signal. In this case, it's not really easy to see where you should set a profit target, more a case for trailing stop loss here, I think. Might also be a good topic for the follow up to this presentation, perhaps tightening the stop here based on the trend state information, perhaps just get out of the trade if you're outside or have recently been outside the second standard deviation and see a trend deceleration. So that might be something that I discuss in the follow-up for this presentation. So coming up next, we'll have a look at how prior VWAP levels can be used to determine key support resistance and also a directional bias. With our VWAP suite, you can see the VWAP levels from yesterday and 2 and 3 days ago. Coming back to the institutional perspective, it's easy to imagine how these prior VWAP levels can be used as opportunities to get in and out of trades. Again, the VWAP and the standard deviation bands are objective price benchmarks. They're the same on all charts and time frames, so it's a good idea to have them on your chart and know that you're at least not trading straight against them when you're entering a position. So you see here, for example, how this VWAP from 2 days ago is area of support resistance in this session. So basically, just follow these. Yesterday VWAP is here. VWAP from 2 days ago is here. VWAP from 3 days ago back here. And yeah, we already discussed how the zero lag oscillator aligns in there and the long-term momentum when identifying pullback trades. But generally, it's a good idea to review a bias from different perspectives. So just as with legal or medical advice, you may want to have a second opinion. And one way to do that is to look at how the market is moving relative to prior VWAP value. So the VWAP value is this shaded area here, simply where the standard deviation bands stopped plotting last session. So this is value area high, value area low. And in this case, we had a break above yesterday's value area, indicating a long bias for the balance of that session. So if we contrast that to the first session that we have on the chart here, we had the opposite, starting trading well below the prior value area here, and clear rejection of the value area low of the last session, creating a short bias for this session here. And if you're trading within VWAP value, you might consider using the regular open to determine a directional bias. On this chart, I've included the 1 minute opening range for the Asian, European, and US sessions, using it as a directional filter. So a number of systems rely on this simple benchmark, so taking long positions when the market is trading above the regular open and short when trading below. So a lot of stuff happens during the first minute of trading, and using this range can give us an indication of where the market will move for the rest of the session. And based on that, we were trading within yesterday's value here, but below the European Open. So we could have participated in this pullback that occurred during the EU session here. Quick note on the premium opening range, we've just released an update to it, so enabling this display that I'm showing here. No overlap between the Asian, the European, and the US, and the reason for that is that we've added a end plot for the opening range, and we've also added a few alerts and sound files with this update, so stay tuned for that if you already have a license for this product. All right, so you might recall this one from one of my initial slides, this aggressive Mariposa reversal candle that we want to watch out for. But the two signals prior were the sort of pullbacks that we're looking for, testing the value area low here and then breaking into yesterday's value and permitting that trade because we're above the EU Open for a directional bias. And we also see that these signals are plotting within the current VWAP value. Okay, so to sum up what we've discussed here today, successful pullback trading depends on the ability to read between the lines and avoid the most common causes for failed pullback scenarios. We're looking for strong trend and momentum, but not wild volatility or pullbacks that show up on aggressive rejection candles. You also want to align the short and the long-term momentum. So we've seen how the zero lag oscillator takes care of that for us so that we can focus on spotting setups that may see institutional participation. So within the first standard deviation of the VWAP, and supplement that with the directional bias from the regular open and where we're trading relative to yesterday's VWAP value area high and value area low. So if it's all right with everyone, we'll transition into the promotion that we've created for this event. We have the opening range here, the session VWAP suite, and the zero lag oscillator, along with a membership for the indicator library. With that, you also get step-by-step tutorials on how to use our tools. And I'll throw in a complimentary consulting session here as well, helping you get everything set up on your end. So list price for this is just south of $900, and at a bundle rate of $695, you got a pretty good discount on this here today. Library membership is pretty much free of charge here, as you see, plus a little discount on top. We also have a special in the membership section. If you're already a member, you know that you already get a 10 to 20% discount on the premium tools, and we've created a special bundle rate for this, extending an additional discount for you guys on this event. So this is where you go to register for the promotion, lizardindicators.com/bundle. And if you've been sitting on the fence regarding the library or some of these premium tools, this is a pretty good opportunity to take advantage of the event special here. So I think we'll have the bundle up for the balance of the week. And yeah, you can head on over to LizardIndicators.com/bundle, check it out, and I'll drop the link here in the chat box as well, so that you can check that out. And if you're interested in the follow-up materials that I'm coming out with in a couple of days, make sure that you've registered for a trial or the Indicator Spotlight newsletter. Then you will get those materials as well. So with that, I'm going to hand it back over to Tiffany and open up the Q&A. You can also get in touch with me, of course, via the contact form over at lizardindicators.com. Otherwise at info@lizardindicators.com. And so let's see here if we can.
You have a couple minutes. If you'd like to go through the chat window, you can look at some questions if you'd like to answer any of those.
Yeah, let me have a look at this here. There is a lizard on my screen. Well, I hope you liked the lizard image of Harry here earlier. Are those all 15-minute candles? I had some of the charts here were 15 minutes. I think most of them, yeah. And then there was 30 minutes. The black histogram lines, there was a question about that. Let me see if I can go back to that here, absence of buyers. So basically, if you don't have a acceleration after you have these short-term oversold setup bars, white bars, then you will start seeing these black bars, and that means that the setup is has been invalidated. It just took too long for buyers to take advantage of it. So it's generally a sign of a weak trend or perhaps a trend change. And so you have to sort of see buyers taking advantage of this within 3 bars of the short-term oversold. Is this comparable with order flow? I'm assuming you refer to VAP, and not really order flow concepts, although it is included in the NinjaTrader order flow suite. There are a couple of differences between our VAP suite and what you get with NinjaTrader. I went over a couple of these things here. I think this is pretty similar to what you have with the NinjaTrader order flow suite, but then we add these value areas and past VAP levels. We also have a rolling VAP, and yeah, a little bit too much to go through all of it here, but if you go to the product page of our premium VAP in the premium section, there is a pretty good breakdown of the features that you get with this. Can you show us for a choppy market? Well, that's sort of one of the points that I made here during the presentation. You don't really want to trade pullbacks in a choppy market. So try to avoid those scenarios. Yeah. pay attention to what the efficiency ratio reading is telling you. Is there a trend here, or was there recently a trend? And try to align that with the short-term momentum, and also pay attention to what the price action is telling you. Can the parameters be set so that only the outer thresholds are used? Yes, you can also specify the threshold levels. So you can move these threshold levels in and out. And if you only want to work with the outer threshold, you simply set the first threshold out to the value that you want to use. Yeah, I think that's it for the questions that I can see here. What time frame do you normally use for the zero lag? You can use it on any time frame daily. For short-term trading or day trading, I would recommend 3 or 5 minutes. And then you can align it as well with a 15-minute chart. Yeah, I've had most success with 3 and 5 minutes for this on a daily VWAP, which is what we looked at today. What's the difference between a rolling VWAP versus a 3-day VWAP moved forward? Let's have a look at this again. So these are showing the anchored VWAPs of prior sessions. So we have the VWAP of 2 days ago here. And if you're using our rolling calculation, let's see if I think I have maybe one of these up here. So if you see this here, this is a rolling VWAP moving time window, so it's not anchored. So I have this set to a 1-day VWAP, rolling VWAP here. So it's taking information from the prior session, moving it forward. And that is quite useful for the, if you're trading the European or the Asian session when you don't have enough weight on the anchored VWAP. So you can use the rolling VWAP for that purpose. If you see there is just not enough weight on it, and you get these setups that plot outside the value here, and using a rolling VWAP will put you in a better position to define this first standard deviation value area during the Asian and European session. All right, so I think that concludes my presentation here today. Thanks a lot for checking in. I hope it's been of value for you guys, and I look forward to seeing you in the membership section soon. So Kris Lassen signing up from Berlin, Germany here. Thanks a lot.
Awesome. Thank you again, Kris, for taking the time to share with us today. If you enjoyed today's session, we hope you'll join us for future webinars. We'd like to remind you the information provided in this was of LizardIndicators and not of NinjaTrader. All information for educational purposes and should not be construed as trading advice. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us at NinjaTrader ecosystem. And again, thank you so much, Kris.
Thanks. Bye-bye.